Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese. Each week, we dive into the important market-moving events and cut through the noise to help you, as an investor, identify what really matters. Let's get this show started. Hey everybody, welcome to the 17th episode of Carson's Facts versus Feelings with Ryan and Sonu. This is The Edge of Normal. Exciting title, guys. We're going to talk about how we see the world in our 2023 outlook. Sonu, first things first, you said you took your kids to a restaurant and didn't bring your credit card the other day. That wasn't very smart.
You remembered. But yes,
Yeah.
So I Martin Luther King Day, I have the day off with my kids, took them to a climbing, like one of the, I don't know if you've gone to a climb zone, which is spectacular. It was my first time there, and the kids going up and rappelling down and things like that. But I was running from one thing to another, and my wallet was in my jacket pocket. And so we then went to the restaurant, and next thing I know, we ordered all this nice food. This is in downtown Chicago, one of the nice restaurants. And I was like, oh, it'll be fun for the kids and me. And no wallet in my pockets. And I was like panicked. I was like, oh no, what do I do now? Thankfully, my wife doesn't work far away. So I was desperately calling her. She didn't pick up for almost an hour. So that entire hour, we were like, okay, how long can I stretch my coffee for? Kids, you guys are having ice cream. You guys are having churros with chocolate, all of it, right? They had
double
a fun time.
dessert.
Double
dessert.
So we just kept running up the bill to buy time. And of course, finally, when my wife gets there, the bill comes, and I realize what I can pay with my phone. Right? Yeah. So I didn't need my wallet. But the good news, I found my wallet. It was in my car. So all's well that ends well.
I think you're the reason we have higher inflation. Running up the bill like that. Anyway, let's get into it. So, guys, we're honored and so excited to discuss our 2023 outlook, the edge of normal. Sonu and I are going to break that down the next half hour or so. I mean, Sonu, you hear the edge of normal. We've kind of talked about it, and we have you hear that, and you get some feelings what that might mean. What does that mean to you as we head into 2023?
Yeah, it's such a good question. You think back to 2020. I mean, when was the last time things kind of felt normal? Probably 2019, right?
I've used this example before. I'll jump in. Sadly, I think the world changed the day Kobe Bryant died, right? Kobe died in January 2020, and then everything got worse. That was horrible. But everything, obviously, with the pandemic. So really, before Kobe died, I think was what I would call the last time things were, quote unquote, normal.
Yeah. And 2020, obviously, pandemic, the world hadn't seen something like that. I mean, big shutdown in the homes, apartments, whatever, right? It was crazy abnormal, right? But then you get to 2021 and everyone thought, okay, the world will get back to normal, right? The vaccines came out in 2020, November. 2021 was, we were all feeling positive. And then by 2022, I think everyone was like, okay, now everything's done. We're behind COVID. But goodness, you think about, from even an economic perspective, right? Three big economic engines of the world, which is the US, right? Europe, all of Europe, and China, right? In the US, you had the Fed raising rates like no tomorrow, right? Fastest rate hike cycle since 1980, 81. And then in Europe, because of the Russia-Ukraine war, talk about an event that I guess for most people came out of nowhere. That sent gas prices up 300, 400%. Crazy. You don't expect that to happen. And then in China, they're still struggling with COVID. 2 years down, 2.5 years down, right? And so all of these things happen at the same time. It was like a horrible, trifecta in a sense?
Yeah, it was a trifecta of pain, I guess you could say.
Trifecta of pain, there you go.
Yeah, all those different things took place. And even 2021, I mean, that wasn't normal, right? The government literally gave people money. We had the big bounce. All the meme stocks went crazy. A lot of people who didn't quite know what they were doing, to be honest, were making a ton of money. And congrats to them. The problem is Mr. Market likes to, surprise the masses. and maybe someone who's done this for a long time, wasn't that surprising what happened, but the air certainly came out of the stock market, but specifically some of those previous high-flying areas. So, Sonu, let's talk about it. Let's talk about the edge of normal here. We think things are going to get back to normal. Guys, we see stocks gaining between 12 to 15% in 2023. We think bonds can gain about 4 to 5%. A little more of a normal type of scenario, even better for stocks. And when we think the economy can avoid a recession, we've talked about this a lot on this very podcast over the last couple of months. So those things are kind of normal, but it's the edge of normal, right? It's not going to be as normal as what we saw in the past. There's always going to be some differences. There's always going to be something that happens. But honestly, we think we're slowly getting back on the path to normal. So, Sonu, let's start with, I think, what's probably how do I want to put this? Our most controversial, I don't know if it's that controversial, but our most controversial call, that our base case is we do not see a recession. Literally everywhere we look, we're hearing economists saying there's a recession. Maybe right now we're going into one. You look at economic data for fun. Let's just leave it at that. I don't know what that means. You forget your credit card and you look at economic data for fun. That sums up Sonu. But nonetheless, I mean, most of what you're seeing, you don't see recession. Give me one reason. Give me the number one reason, in your opinion, we can avoid a recession in 2023.
Avatar sales, Avatar box office.
I've said Taylor Swift tickets. Jesus, remember all the money I spent on those Taylor Swift tickets? Yeah, God, no way you're having a recession with that. But anyway, besides that, yeah.
Right. No, but you talk about the consumer. You look at, hotel reservations. You look at flight bookings. You look at movie box office. All of that. This is stuff you can see, right? Now you look at the economic data, stuff you and I look at all the time. And look, last year, why did things slow? One big reason we had high inflation. Right? People were struggling to keep up with high prices. How did consumption? The consumer actually was surprisingly strong. But what did they do? They dipped into their savings because they had a lot of excess savings after the pandemic, right? Consumers on aggregate in the US saved about $2.3 trillion, and they've spent about $1 trillion of that. So the pot isn't empty, right? But now what's happening? Inflation's coming down, right? Gas prices are coming down. So what does that do to real incomes adjusted for prices? That goes up, right? So I think, this week, all the headlines, I think if you turn on CNBC, everyone's in Davos and everyone seems to be talking about a recession. I think everyone is offsides growth in a sense. I think, wait, real incomes are going up. I think economic growth has to pick up unless everyone in the US decides to save, which obviously we just talked about box office sales, things like that. Doesn't look like that's happening.
No, it doesn't. And let's not forget, last year we saw negative GDP growth in the U.S. in the first and second quarter. Third quarter growth has been strong. Fourth quarter expected to be strong. Most people say, listen, the first half of this year, things could slow down. But again, the Carson Investment Research team, we're saying we don't see a recession as of right now. And it mainly is because the consumer is so strong. But, so that's the economy. Housing has clearly been in a recession. Manufacturing might be falling into it, but just remember the consumer makes up nearly 70% of the economy, and that still is strong. But something else that clearly, is very connected is what the Fed's doing, right? Let's talk about policy for a minute here, Sonu. I mean, what the Fed did last year to fight 40-year highs in inflation, they aggressively hiked rates like anything we've seen again in a generation. That upset the apple cart. That hurt bonds significantly. That hurt stocks significantly. We'll talk about our views on bonds and stocks here in a couple of minutes. We're focused on the economy right now. But, now with the Fed taking their foot off the pedal, can they orchestrate the soft landing? I mean, again, we think they can. But that's the big question. I mean, I hate to put percentages on it. I think maybe 3 and 4 chance we can have a soft landing if I put a gun to my head, I guess, what I would say. I mean, what do you think? Why will we have a soft landing with what the Fed is doing?
Yeah, if not, I'm still waiting for the plane to even look for a runway, in terms of.
And by the way, Gerard Butler, do you like him at all? That movie Plane,
300?
I haven't seen it.
Yes.
No, Plane, where the plane wrecks and he's just running around fighting. Anyway, I love all those movies that guy does. Those the Olympus and every time they attack, I forget what they're called all of a sudden. I just went blank on with the president. Anyway, anything Gerard Butler does is great.
Like Air Force One type of movie.
Yeah, any of those movies he does are just wonderful. Anyway, but Plane, I think of Plane. That was a rough landing.
Interesting.
But back on task, Ryan. Back on task. I mean, why will we have a soft landing here, Sonu?
I think, look, as inflation comes down, it comes back to the consumer. Think of it. Inflation's like a tax, right? And if inflation's coming down, that's almost, think of it like a tax cut, right? So it's going the other way, right? I think that's why we think the odds are that we'll have a soft landing. And in fact, which is not to say a recession is completely like impossible, right? I mean, we're
Sure.
not saying there's a 0% chance for a recession. Like you said, maybe to reverse what you just said, maybe a 1 in 4 chance of a recession, something like that, right? So it's not insignificant. At the same time, our base case is not a recession. Look, the Fed also just raised rates by about 4.25% last year, most aggressive rate hike cycle. And now they're going to wait and see, right? They're going to wait and see. And I think one reason everyone keeps predicting a recession is that they think, oh, the Fed raised rates so much that has to have a
Yep.
negative impact on the economy. And I think our view is like, look, everyone, the negative impact has already happened. Look at
Hmm.
housing, right? Manufacturing too. I mean, and even payrolls, right? Payrolls are strong, but it did slow down, right? It slowed from 500,000 jobs a month to about 250,000 jobs a month. I mean, obviously, we weren't going to create 500,000 jobs a month, month in, month out, but there is a slowdown there, and I think that will continue. But I don't think I don't think we're going to get to a point, especially not in the first few months of 2023, where we're going to see negative payrolls. I mean, dare I say?
Absolutely. Yeah, I've talked about this before. We made 4.5 million jobs last year, the
Yes.
second most ever. We look back 17 times, at least 3 million jobs were created. The year that made that many jobs never had a recession. That was one reason we didn't think we'd have a recession last year. We said this a lot. But the following year, guys, only once, 1974, did we go into a recession after making 3 million jobs. So that's just something to think about. And by the way, it's the Fallen series, right? London has fallen, Olympus has fallen. I knew
Oh,
it
that's the
It'd
one.
come
Yes.
to me. I love those movies. Now we're gonna play a game here, Sonu. You said 1 in 4 chance. I wrote a number down, and if you guess a number, we're going into recession. Give me a number 1 through 4.
Uh, Two.
Oh man, it is 2. We're going into a recession. I'm sorry. See, that totally went the wrong way. That's how you know this is live. But I meant to make it sound like we would not go to recession.
That's how we know
Yeah.
we've been working
Mhm.
with each other for a long
It's
time.
possible. It's possible.
That's there too.
So all right. So let's take a couple more minutes on the economy here. Let's talk about policy again with as it comes to gridlock. One of the things that we put together for our Carson and partners and advisors is we take a look at gridlock, Sonu, and the idea that gridlock can be good, right? The best Washington is one that maybe can't get anything done. We
Yes.
have a split. We have a divided Congress, right? We have very split, darn near down the middle. When we took a look at split Congresses, right? The S&P 500 is up like over 13% on average. Been higher like the last 6 or 7 times we've had a split Congress. Bottom line, yes, there's lots of things to look at. So we're not just saying this is the end all be all. When you layer on top of the fact that, listen, the Fed, foot off the pedal, the consumer, still strong. We're still creating jobs. Inflation is likely rolled over. All these things with the fact that we have a Congress that's probably not going to do too much, which could be a good thing, is positive. So, my question to you: we're hearing all the time. We didn't write about this in our outlook, but it's in the news now. We're hearing about the fact that the government is at $31.4 trillion, or is going to, which is the debt ceiling, which means by June, we might not be able to pay our bills. Similar to this guy I know in Chicago who went to a lunch with his kids and didn't have any way to pay his bills. But he got out of it. I think we're going to get out of it again. What's your take on the debt ceiling?
I Look, the debt ceiling is, I don't want to say it's a gimmick, but it's almost like
Mm-hmm.
the Congress decides to spend, how much on the military and everything
Yep.
else too, right? Half the what they call non-discretionary budget outside of Medicare, Social Security, half of that is defense, right? And they decided to
Mm-hmm.
buy planes and all of that, right? And then they decide, oh, we need to. And by the way, they pay for all that by selling treasury bonds, things like that. Then they decide, oh, we have to raise this thing called the statutory debt limit, right? So it's all
Yeah.
after the fact. They're like, goodness, you already allocated the spending, just raise the debts. I mean, you've kind of acknowledged that you want to raise spending. Everyone's agreed to it, or to whatever
Mm-hmm.
extent, because otherwise the bill wouldn't pass and be signed by the president, right? So everyone's agreed to it, and then later after the fact, they're like, oh, I have to raise my credit card limit, which is kind of ridiculous. But look, I have a bit of a contra view. I think because Republicans have a very small majority in Congress, I think
Right.
a lot of centrist moderates will probably come together saying, you know what, we can't let the uh, U.S. economy go off a cliff here and
Yeah.
not raise the debt ceiling. I think it'll pass. So
No, I agree. I think it's just we don't know. Don't
you'll
want
get a
more
lot of
black
noise.
eyes.
Yeah,
right? You have a lot of noise. It's
a
all
lot of
over
noise.
TV, but like another black eye for Washington, I don't think they're
Yes.
going to want that. Now, let's be honest. In 2011, we saw something similar to where they let the debt ceiling go. And what happened? Well, the U.S. had its debt downgraded. We saw nearly a 20% drop
Right.
in August of 2011 in about 4 or 5 days. Interestingly, what happened, though, the debt was downgraded in the U.S., yet treasuries did amazing during those 3 or 4 days
That,
during the worst of that
that's
sell-off.
the
But
other side
nonetheless,
of it, right?
and that's
You
something, yeah,
downgrade the
yeah.
US and
Mhm.
everyone's like, wait, I need some place safe to put my money. Well, that's
How
the
about the
US.
U.S.? Yeah, exactly. So anyway, so those are our views on the economy. Again, likely strong consumer, Fed taking its foot off the pedal. There are some real reasons to think that we can avoid a recession. Slowdown, sure, but the stock market's a forward-looking mechanism, which we're going to talk about next, and maybe there can be some acceleration in growth next year. Which brings us, Sonu, to stocks now. We see between a 12 to 15% gain. We've talked about a lot of these things before. It's very rare to have stocks down 2 years in a row. During the tech bubble, early 2000s, down 3 years in a row, then 73, 74. That's it. We also had recessions those years. So I guess you could say we've never seen stocks down 2 years in a row without a recession. That, again, is our base case. And when you've had a midterm year that's down, the next year, that's a pre-election year, where we are now, is up 25% on average higher all 3 times. Previous big drops, if you go back in history, stocks tend to do, look at the worst 4 years, back to World War II, when stocks have been down a lot. They're up about 26.5% on average that following year, higher all 4 times. Lots of things to say here, Sonu, but okay. Tell me why. What's the number one reason, in your opinion, you think stocks, we as a department, the Carson Investment Research team, think stocks can bounce back and honestly better than your average year? If your average year is 9.1%, which it is, we're saying between 12 and 15. Why is it going to be better than average?
I love this. I mean, look, we already talked about the recession. I don't think, the economy is going to fall off a cliff. So keep that, back of the mind, right? That's always it, right? And then I look at all the work you've done. I love this chart that you put up on Twitter, and we shared this with our advisors too. Most years are not average, right? I look at most of the outlooks that the street puts out. They're like, oh yeah, stocks will have an average year, 8 to 10%, 7%, 8, 9%. But most years aren't average, right? And then you layer on all those seasonality things, which I love looking at. You have, in years where inflation's going down, stocks tend to do better than average. Okay, that's one check, right?
Mm-hmm.
You think inflation's going to go down. I think most people think that. So I don't think we're out of, consensus there or anything like that, right? And then the year after midterm years tend to be positive as well. And then you take what, Ryan, the first 6 months of, we are in a period of the first 6 months of this year, which is very positive from a presidential cycle point of view as well. So I think there's so many multiple layers coming on top of each other with respect to seasonality. I think that's behind our call. It's not just one thing, right?
Mm-hmm. No, exactly. It's not. It by no means is it one thing. One thing I like to look at though is market sentiment. Right. If everybody's thinking
Mm-hmm.
alike, somebody isn't thinking. General Patton traded options for 10, 11 years, and some of the best investments and trades I ever saw were the ones that when people looked at you like you're crazy, but you had a thesis for why you're doing it. Those were the opportunities. And being bullish, let's call it the first half of 2023, you get some certain looks, but at the same time, look at a 4-year presidential cycle. The first and second quarter are like the 2 best quarters out of 16 quarters of a 4-year cycle. Now, give me 1 second here because I've got some numbers on this. Walter Deemer, he does some really good work. He's been in the industry almost 6 decades. He looked at something called like buying thrust, right? And he calls it the breakaway momentum. I'm going to keep this fairly simple, guys. But the 10 days for trading ending on the 12th of last week, January 12th, the 10 previous days, we saw extremely strong market breadth. Over 2 times the stocks went up versus down for that 10-day period. What in the world does that mean? That's extremely rare. According to Walter's data, that's happened. He calls it a breakaway momentum. It's 24 times it's happened back to 1949. A year later, stocks are up 23 times, up over 20% on average. With some help from our friends at Ned Davis Research, I took a look at the data. I took it even a little step above. And when you have 2.1, which is even higher than what Walter was looking at, advanced declines over a 10-day period, so even stronger type of breadth. I found there are 14 times, Sonu, that's happened back to 1950. 6 months later, S&P never been lower, up about 16% on average over those 6 months. Just one data point, yes. What we're saying with all this negativity, all this skepticism that's out there, the market is giving us a clue. The market is giving us a signal, in likelihood, a very strong signal, this much market breadth the past couple of weeks, that the upward trajectory is going to surprise some people. It's probably going to make some people mad, but that likely could be what happens. So, Sonu, one final part on, maybe not final, but talk to me about earnings and the dollar and how that could be another tailwind that could surprise investors and help the stock market in 2023.
Yeah, one thing to think about there is that, look, the S&P 500 companies, I mean, 40% of revenues come from outside the US. So, so there's a currency impact there, right? Because you're selling goods outside the US, and then for profits to come back to the US in some form, like it has to be converted back to the dollar. So if the dollar is strong, obviously, if you're earning less outside, that has, a negative impact. And I think that's what they have these algorithms that look at earnings transcripts, and I think there was so many mentions of the dollar last year, during company earnings, and to the negative side, nobody's ever, nobody ever talks about the dollar when it's contributed, it's positive, right?
Right.
It's only when it's, when the dollar is appreciating, like, oh yeah, the dollar, that's why, our earnings have disappointed, or revenues have disappointed, and there's a pressure on margins and things like that, right? So, but this, and you think about, why did the dollar go up last year? Well, the Fed was really hawkish. We talked about that. Whereas everyone else, every other central bank in the world was less so, right? Because their economies weren't as strong as the US, and they couldn't raise rates as much. Well, this year we have kind of the opposite, right? We still have divergence, but in exactly the opposite direction. The Fed sort of, as you said, taking its foot off the pedal, right? We're certainly not. I don't think we're going to see another 400 basis points in rate hikes, maybe 25, 50, and markets are predicting they'll even cut rates at the back end of the year. But everyone else is becoming really hawkish, right? You talk about the Bank of Japan, or the European Central Bank, and the Bank of England. Those are three major economies in the world, and everyone else is seeing rates go up. And so those interest rate differentials, which should drive the dollar up or down, I think that's going to send the dollar lower. And that should be positive for earnings.
Yeah, and that's something people aren't talking about, right? FactSet data looks for earnings in 2023 to be up about 5%, give or take. We've seen a lot of cuts from companies over the past couple of months, getting kind of that bad news out there, because that higher dollar, the record higher dollar we saw last year into the early October peak, was a big headwind. It hurt earnings last year, no doubt about it. Very well, this weak dollar we anticipate now could be a tailwind. Don't forget 2015, 2016, last time we saw a big spike in the dollar. Well, along with, I guess, COVID time, saw a big spike in the dollar. But we had a manufacturing and an earnings recession in 2016. The economy avoided a recession and then continued to do fairly well. So we think that's something definitely to watch very, very closely. So, Sonu, we're on the last part. So we talked about the economy. We think we can avoid a recession. Talked about stocks. Actually, one more thing on this. Okay, so you're up 12 to 15%. And again, let's not spend a ton of time on this, but we liked value a good chunk of last year. We said that a lot, that we like value over growth. And honestly, you did that. Things did pretty well. It was growth, your communications and tech, that really, really pulled the market lower. We like small caps as well. We still feel those ways. Is that how you would invest? Let's call it, well, I hate to say let's invest for 2023, because we can change our mind here. But this is our outlook. And we still like value over growth in small caps, right?
I think so. And if you think about value, what's in there, generally speaking, right? We're talking about industrials, we're talking about energy and things like that, right? And you look at the industrials, and one thing to, when I think about industrials, and I want a quick glance at what's happening, I look at the difference between the Dow and the S&P. Right, the S&P is more biased towards growth and tech stocks, right? And you look at the Dow, and that has more industrials, it has more financials, things like that. It's a more, dare I say, balanced index. So everyone's definition of balance is different, right? But I think that gets to, the Dow is what, 5-6% off its all-time highs, right? And that tells you the strength in industrials. And you talk about the global economy. China just released some numbers that look, for the fourth quarter, that look better than expected, right? The economy grew at 3%, which is actually, for an economy that was growing consistently at 5 or 6%, irrespective of what you think about how China comes up with its GDP numbers. It is what it is, right? 3% is a lot less than that, right? Their economy was suffering last year, and I think they're on an upward momentum. And that's going to lift, I think, a lot of the global economy, as I say, positive for earnings and all of that.
Absolutely. The edge of normal, right? We get a little more back to normal. Maybe not totally there, but the edge of normal.
Yes,
You
edge
look
of
at things
normal.
you look at things like copper, industrial metals. Yes, the price of eggs have soared. We're aware of that. But industrial metals, the past, we'll call it 3-4 weeks, have really started to strengthen, likely taking its cue from China, that China is coming back online, which can be a big positive. So there we go. So that's how we see stocks, the economy. Let's take a few minutes on bonds. Bonds had a historically poor year last year. Barclays Ag got over 13%. Worst year in history, back to 1976. Using some data on longer-term treasuries from our friends at Ned Davis Research, it was the worst year for long-term treasuries since like the 1920s. I saw some other data. It's like the worst year for bonds since George Washington was the president. I don't know how they have data back that far. Bottom line, stocks down. Apologies. Bonds down 2 years in a row, with last year being one of the worst years ever. So do we think bonds can gain about 4 to 5% this year? Most of that coming from yield, but that's getting back to normal, right?
Yeah, I think a big factor is the Fed, right? The Fed's going to, I don't think we'll see a big policy shift one way or the other, right? It may come, but I think that's, look, if we avoid a recession, I think there's less reason for the Fed to cut rates. I think a lot of people still expect the Fed to cut rates at the back end of 2023. Where I almost said 2024, but we're not there yet.
Right? Not yet, not yet, Sonu. Just, boy, forget what year you're in, forget your credit card. I'm getting worried, man. I'm getting worried. Yeah.
Getting old. But I think the big story of the bond market is the yield curve inversion, right? The yield curve has traditionally been this quote unquote perfect indicator or foreshadower of recession, and 10 out of the last 10 recessions were foreshadowed by yield curve inversions. But
right.
I think you could put an asterisk on the one in 2019 because of COVID and all of that. But so I don't know if the yield curve really predicted the COVID recession, but it is what it is, right? One reason the yield curve is inverted, I think, is you look at 2-year Treasury yields, or about 4.20. You look at 3-month Treasury yields, they're about 4.70 or so, because they still expect the Fed to raise rates by another maybe 0.25%, 0.5%, right, over the next at the January meeting and the March meeting. But my view is that I don't think it's a recession that bond investors are really pricing in. I think this is pricing in lower inflation. Inflation's coming off the boil. You don't need higher interest rates if inflation's coming off the boil, right? I think it's just as simple as that.
No,
that's why you have it, inverted yield curve.
Yeah, exactly. But then we've talked before, credit markets, investment grade corporate spreads, high yield spreads. Those are still quite calm. And again, to keep it very high level, very simple, when we've seen stress and worry in the credit markets before, that's led to recessions. We have not seen that over the past 6 months or so. So again, do we like stocks more than bonds? Yes, but there's always a place for fixed income in someone's portfolio. And after just the devastation that a lot of people have had, unfortunately, in fixed income the past 2 years, we think we're getting a little more back to normal. And you can gain between 4 to 5% in your bonds, and little safety, right? Maybe zig when stocks zag. I mean, that was
finally
so devastating. Yeah, so rough about last year. Was the stocks did poorly? Well, we've had poor years before when stocks have lost 20%. But you know what happened? Bonds historically have done quite well in that scenario. It didn't happen last year. We think we are getting more back to normal. So, Sonu, this podcast is a lot of fun. I don't want to give too much away, but next week you and I are both going to be in Omaha at home office for a big,
on the road,
big meeting we're having on the road. We're going to do something really special. Everybody's got a podcast. Everyone does something. I promise you guys, what we've got in store for next week's podcast, nobody's ever done something like this. So hopefully I got your interest there. I made it sound even better than it's going to than it's really going to be, but it should be fun. What we've got planned.
Hopefully it'll be actually on the road too. So.
Yes, pun intended. Actually on the road. Maybe give a little bit away there on 4 wheels. We'll see. So, all right, guys. Well, Sonu, thanks for a great discussion as always. Thank you to all the listeners out there. This podcast is so much fun to do. The Carson Facts versus Feelings. We've had a lot of listens, a lot of downloads, a lot of likes, a lot of positive feedback. And just last week, me not realizing that there's such thing as coal flavored toothpaste was a big hit with a lot of people. So yeah, it actually is. You squeeze it out and it's totally black, and you're thinking, oh my God, what did I buy? And you realize, oh, it's a coal flavored toothpaste. So
wow,
anything's possible. So guys, we'll be back next week. Hopefully you enjoy the Outlook 2023, the Edge of Normal. We are releasing that this week. Please take a look at it and check it out. With all that, we'll be back next week with a very special on the road edition of Carson's Facts versus Feelings. We'll see you then.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.